Hey guys, it's Crossroads here. Today I wanted to talk about two positions I exited completely and what I bought with that money. As you may know, I have 10 total positions, or had rather, and I'm down to eight. And I wanted to talk about those two, the reason why I sold and what I did with the money, certainly as well. Bottom line is when I exit a position, it's for one of three possible reasons. One is that the thesis has changed completely. That's not the case with either of these two companies. I think the thesis is very much intact. Two is if I need the money for something personally. If we're buying a house, we're buying a car, something comes up, a large purchase, and we need cash or an emergency hits that exceeds what our emergency cash is, then I'll sell something and take care of that as well. Lastly, is if I see an opportunity in the market and I have higher conviction in that opportunity, I'm not allocated enough to that, that's when I'll make another change. And that's the case for both of these companies. But I did want to give you an update on that and kind of show what that looks like as well. So the two companies that I exited are Enphase and also AbCellera. So we'll look at Enphase first. And Enphase may surprise you a bit. I've talked about it, had a couple of interviews on this stock. I'm still very bullish on this company. This is one of the jewels of the solar industry. Difficult thing is with the solar industry, they are very much in a bear market, and it's hard to get an understanding of when that will end. However, I don't want to be out of in phase for very long. I hope to get back in during the second half, even if it's in the 80s. Honestly, at that point, things could be looking up for solar. But Enphase itself, they posted quarterly results, and it was actually pretty interesting that they came out. You can actually see that a lot of the numbers, solar deployed, revenue by region, microinverters shipped were down just slightly, and revenue as well as net income were up. Cash flow looks good. They also announced a whole bunch of partnerships through the first year, and they developed and deployed their I8Q products as well, which are really compelling. But you can just see here the list of all these different agreements and partnerships that they made. They're doing very well. So what's the issue? Why am I out of Enphase? Well, I saw a better opportunity. Enphase is very much a wait and see opportunity. I know at some point in the future, solar will not be in a bear market. These guys have survived two bear markets before. They're very well managed. They will survive this one no matter how long or short it is. The difficulty is we don't know exactly when this will inflect, when they'll actually see the solar renaissance and things continue to go the way they were before and enter into that bull cycle. We also need to keep in mind that they had about $50 million of safe harbor credits, which is basically forward purchases, forward agreements that they usually give some sort of concession or discount. So their revenue is okay, but it does come at an expense of something in the future. The main idea there is just to make it less cyclical, and I think it's a good plan for Enphase. A big part of the Enphase story is rates. This has a double-edged sword type of event. A big part of the Enphase story really does come down to interest rates, and we can see that the 10-year yield has actually fallen quite a bit this year. That's one of the silver linings of what's been happening in the economy recently, and hopefully that will continue. If we zoom out, we can see the last 3 years that it's been a challenge as those rates continue to climb. The 10-year directly infers where the mortgage rate is. So the higher the 10-year yield, the higher the mortgage interest rates are, and also tends to be the higher rates are on something like solar. Of course, if interest rates are very expensive, people will tend to get less of them because they'll see less of a savings versus their energy bill, although some will do it anyway. That's great for them, but not everybody can afford that. Also, as people tend to move and move more aggressively, as mortgage rates are lower, then they tend to adopt solar systems a lot more often. For instance, I know some people that have solar in their house that they plan to move. And even if that house does not come with solar, they'll be sure to get it installed because they really like that setup. So with the rates being epically high, it's been very difficult on both aspects and both fronts for Enphase. So watch the 10-year yield. If this continues to fall, especially if it gets under 4%, I think we'll continue to see a little bit more momentum in solar, but it will still take time to play out. Again, I do hope to rotate back into this in the second half, even if it's a higher amount. Now, the second stock that I exited completely, I mentioned before, was AbCellera. You may not have heard of this company. It's actually an international company, one of two that I owned. Now I only own one, which is Nubank. But with AbCellera, it's a biotech company. The way it works with biotech companies, the most important thing is their cash runway. And so let's take a look at that. They put this slide at the very beginning of the earnings call because they know, hey, they're biotech. This is the most important thing to keep investors updated on. They moved into a new headquarters. They have $840 million available in liquidity. Some of that is also through a grant as well. They mentioned a number of clinical trials, partnerships. Those are great things. But this right here, because it will take years for them to develop their products and for their partners to develop products, they need a long cash runway. So they did a good job of outlining and showing like, hey, they don't need to raise capital anytime soon. It also helps if the founder is a net buyer of his stock, and that does that immensely. And they went through and just kind of outlined the thesis, reminded people of these different products that they have in their own pipeline, as well as where their partnership agreements are. And you can see the timeline on a lot of these things. 2025 Q2 anticipated for submission. Not the biggest deal. The phase 1 readout, which is in 2026, is a bigger deal for ABCL 635 and 575. But it's still years and years away. And you can see where they are as far as these pipelines here, that in the next 18 to 24 months, they have some key milestones for things that are in their pipeline. Partners may get there first. They do provide some revenue for AbCellera too, so they're not they're revenue negative, but they're not making nothing. But yeah, this is years and years away. It's a wait and see play that as I was investing in it, I'm like, hey, that's great. And I think that they have a compelling potential use, but it was a very small holding for me. It was actually under 1% in my portfolio. I did grow it over time, but I thought, you know what? There's a wait and see play that I see the trajectory. I know when that's going to turn around, and it's very, very safe. So I sold AbCellera completely, and I don't know when I'll get back into that. Not a high priority. Sold Enphase completely, but I hope to get back in the second half. And I bought a lot more PayPal. That's right, PayPal. So why would I buy PayPal? Why is it so compelling, especially here recently? Enough so that I'm not only DCAing into it, but I actually sell out of two of my positions entirely and use a good chunk of that money to buy PayPal. PayPal is, in my mind, a wait and see play as well. I didn't think that going into the year. It seems like at least for the first half, kind of for the second half, but not as extreme. It's very much still a transition year going after last year. Now, part of that is they're shifting Braintree in its strategy to, instead of growth at all costs as far as revenue, they're taking margin into consideration, and that's really helped their bottom line. But their top line has grown much, much more slowly. It's actually a 5% revenue growth headwind. So not attractive from the top end. That'll continue through the first half into the second half, less so. But the bottom line looks really good. And I thought in Investor Day, they really laid it out well where PayPal is at. So let's take a quick look here. This is showing a couple of timelines. What they did in 2024 is exactly what Alex Chris said that they would do, that they would return to profitable growth, that they were all about pricing to value, and of course, building out their ecosystem, launching these new products as well, and forging partnerships. And they did that. You saw especially a lot of it in August. That was an exciting month for PayPal. And in 2025, it's about scaling these. So scaling omni-channel, growing Venmo. Venmo is doing extremely well. Small and mid-sized business growth and winning checkout as well. And then launching not just from a payments platform, but a commerce platform. So let's look at what that means as well. So over the years, this is what this looks like. So the non-GAAP EPS growth and transaction margin dollar growth. This, if you're not familiar with, it's a PayPal specific term, but you can think of it as net income. That's essentially what that is. So net income, they're like, hey, we'll get at least 5% growth. You'd be like, man, that's really terrible. That's bad. That's not great. If it was all that was there for this year, is like, hey, we're going to do 5% perpetually. Ooh, that's not a growth company. It's certainly not a growth year. Non-GAAP EPS, they can control that through expenses as well, but that's 6 to 10% growth. That is better, but not particularly exciting. It's okay. As they accelerate into 2027, we'll see high single digit growth. So that's probably 7, 8, 9%. And they may even hit double digits. Now, the thing is with PayPal guidance, Alex Chris put it this way. He said, we wouldn't guide on something unless we had very clear line of sight that we're going to hit those targets. And so this isn't a, we hope we get there, or there's a coin flip if we'll get there. It's like, we're for sure going to get there, barring some crazy black swan event. And there's a good likelihood of some upside as well. And so looking out further as well as they accelerate their product stack past 2027, which I know is a couple of years out. That can be a long time for a lot of investors. Note this is by 2027, so it's not, you have to wait beyond that. They're looking at 10% transaction margin dollar growth, which is net dollars, net income. That's really good. That's actually a growth story, and 20% growth plus for non-GAAP EPS. So what are these products? What are the imperatives? You can see it right there. Win, checkout, scale Omni, grow Venmo, accelerate small and mid-sized business. And this is the last slide that I'll show you on this. They had an incredibly siloed PayPal before. It just had a bunch of different components that the prior leadership purchased, brought into the ecosystem, kind of, and then they put it in a separate building. Very little communication, very little actually networking between the two, different sales teams, different HR teams. Didn't make a lot of sense at all. And now they're integrating them into one platform called PayPal One. That takes time. They have PayPal, branded PayPal, Zoom as well on the system, and Zoom. Both of these actually are using crypto. Zoom is backended by PayUSD. Zettle, which is that POS terminal that they have that's mostly in Europe, but it's still around here in the United States. They're incorporating that in the first half of this year. Venmo throughout the year. That Venmo, by the way, prior to Alex Chris, you could not even send money from Venmo to PayPal. It's crazy. It had lower margins than PayPal, so it was competing head to head. They know what they're doing now. New leadership is impeccable. And then later, of course, PayPal Complete Payments and PayPal Braintree in the second half of 2025 and 2026. They'll have identity, risk, service, compliance, and payments all in one platform, all in one integration. It just helps them so much. As a business, helps the stock as well. But those take a little bit of time to plan out. What I loved is they gave a very concrete plan of measurable goals, what they're doing, why they're doing it, how they will hit those targets. And they have, up to this point, met or exceeded all the targets that they've tried to set out. And so I looked at this after Investor Day. I'm like, hey, PayPal is now a wait and see play, which is not particularly exciting, to be waiting and seeing. I know it's frustrating, and there's a real chance of it being an opportunity cost. But I realized I had 3 of those in my portfolio between Enphase, AbCellera, and PayPal. And boy, I have a lot more clear sight of when and where PayPal will go from here as a business. I still think by 2030, we'll see this company at an all-time high. Now, let's talk about the stock price action as well, because that's part of this too. So PayPal is back in the 70s, which sounds terrible, but it was down almost to 65 at one point in the pre or after hours. It has fallen tremendously year to date, down 18.22%. They had solid results in quarter four, weren't amazing. A lot of that was that Braintree mix shift that they're doing as far as a strategy. And over the last year, it's up, 20%. That's not great in a bull market. Not great at all. I'll just be honest. What makes this very interesting, though, is essentially the stock has become de-risked. So if we look at a couple of the ratios, the current PE is 17.63, which that's pretty low. You look at the forward PE ratio of 13.91. Price to free cash flow is 10. They're buying back $6 billion of their stock, and they have less than a $70 billion market cap. That's insane. Free cash flow yield is almost 10%. That's amazing. That's ridiculous. They have $20 billion allocated to buybacks over the next few years. And so you look at this market cap and it's like, okay, if you subtract 20 billion, and I know that doesn't quite work out because you don't know where the share price will be. Hopefully it'll rise. It'll likely rise. And also there is some stock-based compensation that offsets that. But hypothetically, if you take away $20 billion from that market cap, the valuation of PayPal, that PE, looks absolutely silly. And so it means when I'm looking at PayPal, I would rather be sitting in PayPal than cash for the most part. Now I am buying the dip on a lot of names very gradually and slowly. PayPal, I went a lot more aggressive this week just because of selling out of Enphase and AbCellera. I see it as a very, very low risk at this valuation, very low over the long term. Anything can happen in the next 12 months, but longer out, I see where the company is going, but there's a risk of opportunity cost. But it's the same risk with all three of these. Just made sense to rotate into my strongest conviction. So that's what I did is I sold out of Enphase, I sold out of AbCellera, and I bought a lot more PayPal. I'll do a portfolio update here in the next few weeks as well, just to kind of show you that allocation and where it breaks down. Let me know what you think in the comments. I know that there's some folks out there that have done the opposite and have really rotated in Enphase, and it can absolutely be the right thing to do if you have a higher conviction in Enphase than some other companies that you're holding at the moment. So let me know what you think in the comments, where you're at with PayPal. Perhaps you're holding Enphase or AbCellera. Fine companies, and I hope to get back into both of those. As always, thank you for watching, commenting, and subscribing. For now, happy investing.